and welcome back. In the last session we introduced market efficiency and the efficient market hypothesis. You recall that hypothesis says that as a practical matter, the major financial markets reflect all relevant information at a given point in time. For practitioners, the major implication is that it is impossible to beat the market. Today's session will take a look at some cases where the market didn't work exactly the way it was supposed to. In particular, we'll introduce the idea of market anomalies, and we'll look at market bubbles and crashes. Anomalies are described as incidents where aspects of stock price behavior is baffling and potentially hard to reconcile with our understanding of market efficiency. Essentially, patterns may appear in the market that allow investors to capitalize on that bit of inefficiency. We call these market anomalies, and three important things to remember about all kinds of market anomalies. First, they generally do not involve a lot of money, not in terms of the general size of the market. Secondly, when we do see anomalies, they tend to be fleeting and disappear once they're discovered and investors start to take advantage of them. Finally, anomalies are not easily used as the basis for a trading strategy because the transaction costs incurred to exploit them may actually outweigh the benefits. We do see that over time there have been an innumerable number of cases of anomalies. One that's regularly discussed is the dogs of the Dow. A great name. Essentially, it highlighted the fact that certain companies that are traded on the Dow index, which only has 30 stocks, the low performers, or the dogs, tended to become high performers in the future, especially when we looked at things like dividend yield. So this particular approach, this particular idea of capitalizing by investing in high-yielding Dow stocks, perhaps the 1, 2, or 3 worst performers and the highest yielding as a result, tended on average to produce a better than average rate of return. Of course, once people recognize that, it does tend to drive up the price, drive down the yield, and the effect disappears. Three particular effects that they discuss in our textbook include the day of the week effect. The main proposition: Mondays tend to have a negative average return. I think anyone can appreciate how Monday might actually be seen as the worst day of the week. In this case, it was proven financially. When we take a look at the effect of returns on Mondays over a long period of time, in this case from 1950 through to 2018, we see that there was a negative return on average over that entire period of about 0.5%. Sorry, about 0.5%. But we do see that the effect, when we disaggregate the sample into two time periods, 1950 to 1980 and 81 to 2018, was much more pronounced in the first half of that time period. And so once the effect was identified and traders became aware of it, it disappears. So it's a great example of the fleeting nature of these anomalies. The January effect essentially says that there's a tendency for small cap stocks to have larger returns in January. Interesting question then, does the January effect exist for Standard & Poor's companies, for the larger companies? And so the test was made from 1926 through to 2018, and we see that there's no significant difference between January and other months in the rest of the year, at least not for the Standard & Poor's index. When we look at the effect for small cap companies, on the other hand, we can see that January does provide a significantly larger rate of return. Now, there's no clear indication of why this is or whether or not this is persistent. It still continues to baffle researchers. The turn of the year effect may partly explain this. And in this case, we're not looking at January versus December, but we're saying, let's take a look at the immediate weeks right around the end of the year. Now, we know a number of interesting things happen at the end of the year. Individuals and organizations may decide to take profit for tax purposes or to realize capital losses for tax purposes. That may have something to do with it. So rather than try to find an explanation and a grounded theory, just observing the data provided some insights. The first question was, does this affect all of January, or is it just due to the bracketing at the end of the year? So to study this, the researchers looked at a specific 3-week period. Essentially, the first 2 weeks of the returns in the next year and the last week of returns in the previous year. And that becomes the turn of the year days. The rest of days were the days that were not in that particular time window. And from our textbook, we can see the results show that the turn of the year results on average over the entire period from 1962 to 2018 showed a significant higher rate of return for turn of the year days than for the rest of the days. So a substantial difference. As with the previous example, with the Monday effect, you can see that return or that difference was much more significant for the first part of the sample. So for the years from 62 through to 1990, the returns were significantly different, but much less so for the rest of that period. Again, once we recognize an anomaly, it tends to disappear. Similarly, we can look at the turn of the month effect. And here we've got the same kind of analysis. For turn of the month, we say what are the daily returns for the last day of a month and then the following 3 days of the next month. And again, from our textbook, we can see that over the entire period from 1962 to 2018, there was a significant difference in the turn of the month days relative to the rest of the days, about a 6% difference. But that was again most significant in the first part of the sample, 1962 to 1990, with a difference of about 8 or 9%, versus the last couple of decades where it was much less significant. So those are a couple of examples. You'll hear about a lot of other examples of anomalies. They tend to, as we said before, exist for a short period of time before they're exploited, before markets recognize that they exist, and before investors will start to capitalize on those differences and make them go away. One of my favorite was odd lot theory. Essentially, it said that small investors tended to buy shares in odd numbers. Round lots or whole lots essentially were a block of 100 shares or 1,000 shares depending on the price. And large investors tended to buy round lots. Small investors tended to buy odd numbers. And so if the odd lot interest was high, then that was probably a stock to avoid, because whatever the small investors are buying would probably do badly. Now, that one again is no longer as relevant because we don't see that kind of trading pattern anymore, but it was an interesting one for quite a while. Our next topic takes a look at the happy topic of bubbles and crashes. Clearly, everybody's heard of bubbles and manias and panics in markets, and essentially this is a case where the markets are not acting rationally and certainly not acting efficiently. We know that a bubble tends to occur when the market prices itself far in excess of normal levels. There's no rational reason for people to buy into a market so significantly overpriced. Perhaps it's that fear of missing out that we hear of. Maybe that's happening today with things like Bitcoin. People are definitely concerned that there's going to be an important opportunity and they're missing out. Eventually bubbles pop, and when they pop, they may may result in a financial crisis that can last for weeks or months or even for years. One of the first examples that I'm aware of started off in the 1670s in Holland. At that time, there were both stock markets and bond markets, and we also had an agricultural market that would trade in things like tulip bulbs. Certain tulip bulbs became so valuable that owning the right kind of planting stock could actually mean the difference in a successful or an unsuccessful family fortune. Some tulip bulbs went for as much as $1 million per bulb during the peak of the tulip mania. But like all bubbles, eventually it burst, created a crash, and nearly brought down the most successful trading economy at the time, the Dutch economy. We saw this with the railway bubble during the 1850s and the South Sea bubble. The one that everybody's most familiar with, I think, comes with the stock price bubble that followed the railway bubble in the 1920s. We'll talk about that in just a moment. Crashes are essentially a significant and sudden drop in market values, typically associated with a bubble, not necessarily. They tend to be sudden, last less than a week, but the results of a stock market crash can last for years. We have studied extensively crashes, panics, and bubbles themselves. A great example, a great book about this, is one that's been updated several times in recent decades by Charles Kindleberger. Essentially, it's a textbook for central bankers on how to avoid financial collapses. One that every central banker has certainly read, and probably one that they haven't always learned from, because a follow-on book to that by two central bankers, both professors and central bankers, great economic thinkers, essentially said that everyone is convinced, every government leader, every central banker believes that this is different. Now is different than then. We're not going to make the same mistakes we made before. You could even go back to the 1920s when bankers, economists, politicians, and other leaders all believed that war could not possibly occur, knowing what we know now. Now that's why they called the First World War the Great War, because they thought that's it, that there'll never be a second world war of this type because we've learned our lesson. Similarly with financial collapses, people say, well, we've learned our lesson this time. It creates a kind of hubris or pride among central bankers saying that we've learned our lessons, it's never going to happen again. One of the greatest central bankers ever, Alan Greenspan, fell into this trap, essentially saying that no longer will we see a financial collapse of the kinds that we've seen in the past. And at the very end of his tenure, he had to deal with the complete collapse of the American financial system in 2007, 2008, something he said was largely impossible because of the control of monetary policy. This kind of thing will never happen again. Well, to take a couple steps back, an earlier crash, one that was considered to be the Great Crash, right up until 1987 when the next one came along, was the crash of 1929. The first major financial crisis for the developing American economy, the first time we'd ever seen a true and national recession in the United States. October 25th, 1929, the Dow Jones average was at about 301 points. It closed up by about a point. Everything seemed to be quite normal. The next day, the Dow Jones closed down at 230 points, with a daily low point of about 212, about 30 points lower 30 points lower than the closing level on the previous Friday. That day became known as Black Tuesday, with a total volume of about 16 million shares, about 4 times normal trading levels. Of course, that's the event where we see bankers and investors throwing themselves off the new skyscrapers in New York, and clearly created a major loss if you sold at that point in time. But the worst news wasn't that there was a week of really bad news. The really bad news was that it led to a period of market stagnation, followed by a lot of the wrong government policies that led to a general decline in the American economy from 1929 right through until the 1930s. This was exacerbated as well by government policy that included things like controls of imports, a type of mercantile trade practice that had never been successfully tried, and led to an increasing isolation of the United States from the rest of the world. The Dow Jones Industrial Average actually did not recover fully from this until about 1954. It didn't reach its previous levels of index levels until 1954, more than 25 years later. One crash that I'm actually familiar with, partly because I was an MBA student while this was happening. In October of 1987, we saw the crash of 1987. Up to this point, when somebody mentioned the crash, they meant the previous one in the 1920s. It started on a Friday with the Dow Jones falling 108 points in one day, closing at about 2,246. First time that the Dow Jones Industrial Average had fallen by more than 100 points in a day. The next week was when things got really interesting. And on Tuesday, October 19th, the Dow Jones lost about 22% of its value on a record volume of about 600 million shares. The loss itself was a problem, but the volume became even more important. Every stock that was listed on the Dow, in fact the Standard & Poor's Index as well, lost value in that day. Everybody was selling, nobody was buying. The market was in complete disarray. Part of our interpretation of what happened on that day, that Black Tuesday, was the day the machines took over. Machine trading, automated trading, tended to make things a lot worse. It exacerbated a bad problem. So as trading levels started to fall and prices fell, stop loss orders kicked in. There was nobody to take up the other side of the contract, so prices fell even more, and which triggered more stop loss contracts. And the irrationality was not just the irrationality of the day, but it was the irrationality of the design. So we had to be able to fix this. In 1987, the crash in 1987 actually was followed by a recovery when people realized this was an irrational crash. It really did not need to happen. The market wasn't really overpriced the way that it had been in the past, and so we started to see a recovery. And people started to say, why do we make such a stupid mistake? One of the responses that we saw was the eventual development of something called a circuit breaker. It did take a while. In fact, by 1998, they hadn't fully developed the circuit breaker system, and it was upgraded right up until 2013 when we had a similar type of automated trading scare. Circuit breakers are essentially triggered when the market falls by a certain level, 7, 13, or 20%. We have level 1, 2, and 3 circuit breakers. Level 1 and 2 circuit breakers kick in and stop the market for 15 minutes if they're triggered. If the market falls by 7% during the trading day, then there'll be a 15-minute break. If it falls by 13% during the day, it'll also call a halt for another 15 minutes. And you could actually have both triggers happening at the same time. Level 3 circuit breakers happen when the market falls by 20% during any particular trading period, and trading is halted for the rest of the day. It can also apply to a particular stock or the entire index. Now, this is designed to stop the kind of collapse that we saw in 1987 and the smaller one that we saw in 2013. In fact, the one in 2013 is still being investigated and may actually still lead to some charges being made because of one particular firm's misdeeds. We have had a number of other interesting examples. They're interesting because they're very different. One of them is regionally focused and the other is sectorally focused. And they're both more recent ones as well. The Asian financial crisis followed the crash of '87, and it was like the crash of '29 because it not only created a really bad trading day or really bad few trading days, but led to a decline in certain markets like the Japanese market for years to follow. The problem that we saw with the bubble that led to the Asian crash started in Japan, and it started in the real estate market, where there had been a gradual build-up of real estate prices to the point where the prices were ridiculous. Real estate prices went up by about 70 times from 1955 through to 1989, and The largest owners of real estate were companies, and as a result, stocks of companies, especially financial companies, went up more than 100 times. So we have classic bubble situation developing, and focused principally in the Japanese market. The Japanese market was driving the Asian market up to that point in time. And so when Japan collapsed, we saw a cascade of financial market collapses across Asia. It started off in Japan, but investors started to realize that certain other markets were particularly weak. Countries with large trade deficits like Thailand, Malaysia. We even saw Singapore have a version of this because it was made up of mostly financial assets. And so the result of this was a regional collapse that affected the entire world market, but was focused in that market. And as a result, we see this from the Nikkei, but it was also reflected across Asia. We saw it went from a peak of about 40,000 on the Nikkei index down to about 10,000. And still has not fully recovered from that point, and led to a downturn in markets and an increased difficulty in raising capital. Another interesting crash that we saw, one that many people will remember, that the internet crash, or the dot-com bubble and crash, created one of the most interesting collapses of our lifetimes. This started off because of the absurd valuation of certain internet stocks, the dot-com stocks. Anything that had dot-com after its name became immensely valuable, regardless of the company's financial performance, its revenue model, its business model. Companies became incredibly valuable. If you did an IPO and you floated an internet stock, you didn't have trouble finding people to invest. Again, fear of missing out. People were borrowing money against their houses to invest in the stock market so they could buy shares in companies, some of which you'll remember, some of which you'll know, like Amazon, and some of which are very forgettable because they've been long gone. They disappeared, they collapsed, they were merged into other companies as a result of the dot-com crisis. We can see from this chart that compares the behavior of the IIX index, or the American Exchange Internet Index, the red line, to the remainder of the Standard & Poor's Index. And clearly, the Standard & Poor's Index did have a bad time because of cross-listings or inclusion of many of those internet stocks, but internet-specific companies were by far the worst hit. The next crisis, of course, was the financial crisis in 2008-2009. Now, that of course started off with a weak condition in certain financial institutions, partly led by very poor financial infrastructure, and especially in the United States. It started off with mortgage securities that were the basis for collateral for a lot of other financial institutions. So when a couple of institutions got taken down, a number of other institutions found themselves in financial distress. As a result, they had to recapitalize, and while they were recapitalizing, they weren't in a position to provide credit, which meant that the world supply of available credit to build businesses, to build houses, to finance our lifestyles pretty much dried up, and the economy went through a few very bad years. In fact, it's interesting that the United States recovered from this faster than Europe and many other world economies. And we could see that happening, of course, going from a peak in October 3rd of 2008 down to a value about 2,000 points less by the 10th of October. And recovery didn't really happen until about 2011. Right, we had a chance in this session to take a look at a number of different events that contradict our idea that markets are efficient. If markets are efficient, why did they not see these problems coming? Why did they allow us to create such massive bubbles? We saw that certain anomalies have been noted, although we also recognize that once they're identified, they tend to disappear. We looked at bubbles and crashes. Over time, we see that Bubbles, once they form, typically lead to a crash. A crash may be followed by a recession. Not always, but maybe. And we saw several interesting and different examples of those. Do you remember I mentioned Reinhardt and Rogoff's book, This Time Different? Or This Time Will Be Different. Is it? Do we expect to see another recession, another bubble, another crash during our lifetime? It's one of the things that people are talking about every day now. For example, current headline from Forbes, will inflation cause a stock market crash in 2022? Or perhaps will a geopolitical event, like a war in Eastern Europe, cause that kind of a collapse, that kind of a crisis? I don't know. I'm as a believer in the efficient market hypothesis, I hope that we've already fully priced that in and that our markets will behave rationally in the future. Our next session is going to take a look at behavioral finance and some of the reasons why markets may not behave efficiently. But more about that later.